Welcome back to another Jerome Powell speech. This is going to be a critical speech. Basically, all stock indices are flat at the moment. We've got Brent at 91.44. We've got the 10-year Treasury going as high as 4.98% after jobless claims coming in weak this morning. Now presently sitting at 4.936%. Jerome Powell scheduled to speak in about 3 minutes, so we'll be covering this live. I want to be very clear. This economy, if I was Jerome Powell, and I'm not Jerome Powell, okay? I just want to be very clear. The economy is actually doing pretty well, okay? I know that sounds painful because things are so much more expensive, right? Prices are up like 20, 30%. Of course, that's painful. It's painful for people who have less money. That's horrible. But the jobs market is holding up. Unemployment is holding down. We've got earnings at companies that, maybe they're a little flattish, not as great as they used to be compared to COVID days when we were printing money like crazy. But we've still reset to such a higher level than where we used to be. The economy's not that miserable. That's one of the reasons rates are so high. Now, the question is Jerome Powell going to be fearful that they've gone too far? That's the question. So far, there's really no sign that they've gone too far. There's some small business stress, small businesses being the ones that are paying higher interest rates. So we do have that sort of stress, and we have this fear that something's going to break again, but so far nothing has. And when and if something does break, the Federal Reserve has a lot of latitude to drop interest rates rapidly and help essentially turn the money printer on when they need to. But again, initial jobless claims this week expected to come in at 210,000, came in at 198. We had the prior weeks revised up slightly from 209 to 211, but that's still a net miss of about 10,000 jobs here. Continuing claims actually came in a little bit higher, but that didn't get the news because what gets the news is the fact that we've had the lowest number of initial claims since January of this year, which is when we were having more layoffs than certainly we're at the moment. That's not to say that there aren't still talks of layoffs, but there's also a lot of rehiring going on. And this is what's confusing a lot of folks, especially the Federal Reserve. So we'll find out. Federal Reserve, Jay Powell expected to speak in just a moment now. We're probably about a minute away. We've obviously got a lot going on in the market today, from a leadership Tesla dropping to a new Fibonacci low, sitting right at that 220-ish region, which is what we talked about could happen in the event of a bad earnings call, that Fib really holding Tesla. And we'll do a separate video discussing the leadership problem that exists at Tesla right now, but you're not going to get that kind of insight scrolling around to see what other pure Tesla bulls are saying. But we'll focus on the Federal Reserve here. Federal Reserve expected now to speak here within about 15 seconds or so. Let's see what CNBC is saying for a moment while we wait. Oh, wait, actually, just as I'm tabbing away, it looks like they're getting ready to launch this. Let me see here. No audio feed yet. We're good. Okay, that way we can add commentary. Let me listen to CNBC for a moment.
That oil's gone green. The VIX once again kissing 20. So even though the market's going into Powell pretty even-handed, keep an eye on some of the other metrics as well. Frank Holland in for the half. Let's get to post 9.
Carl, thank you very much. Welcome to the Halftime Report. I am Frank Holland in for the Judge Scott Wapner. We begin with breaking news. Fed Chair Jerome Powell just about to speak at the Economic Club of New York. Let's get straight to our senior economics reporter, Steve Leisman. Steve?
They just released the statement. More evidence of above-trend growth or labor market no longer easing could warrant further monetary policy tightening. Extent of additional firming and how long to keep policy restrictive will depend on data. Same thing we've heard. Policy stance is restrictive. That's a big line. Just coming through. We've got committed to achieving sufficiently restrictive policy stance, but they just said policy stance is restrictive. So I guess achieving sufficiently restrictive. So are we restrictive or sufficiently restrictive? Whatever. There may still be meaningful tightening in the pipeline. We're now tasked with the balance of tightening too much versus tightening too little. Still waiting for Jerome to actually go live here, but this is going to be from a statement. Inflation is still too high. Lower summer inflation readings were very favorable. However, the September data was less encouraging. It's not great. A few months of good data is only the beginning of what it will take to build confidence on an inflation path. The labor market is tight, but gradually cooling. So pretty neutral here. Return to 2% likely to require a period of below-trend growth. Some further softening of labor market conditions. Attack on Israel. Prospect for more loss of innocent lives is horrifying. Fed's role is to monitor the highly elevated geopolitical tensions. and these pose important risk to the economy. We do not have any kind of audio feed yet from Jay Powell. Let's listen to the commentary here, the same summary I probably just read.
Fed's goals of maximum employment and stable prices. He says the decline in inflation over the summer was a, quote, very favorable development. And he talked specifically about the September data. He said it did show a continued downward trend, but was somewhat less encouraging. Short-term measures of core inflation, he says, are now running below 3%. But he warns you, a few months of good data are only the beginning of the Fed getting enough confidence to come off of the rates that it has now. He said, you can't.
They're trying to get this figured out. Oh, wow. Okay, we'll wait for them to figure it out.
In the quits and also the decline in the wage premium for job changers. Finally, he notes that geopolitical tensions are highly elevated and pose a risk to the global economy, calling the attacks on Israel horrifying. So, Frank, there you go. A little bit of something for everybody in there.
Yeah.
I think ultimately what you walk away with is this idea of the committee is going to proceed carefully here, and it is going to take into account all of the data that's coming in, and there is no decision yet on what the next move is from the Fed.
You know, Steve, I know you're saying that's what you walk away with, but give us a sense. You've read the.
By the way, we're waiting for Jerome Powell to actually come up. This is what we have right now from the feed from them, and their audio is pretty miserable here. Let me check it now. Oh yeah, the audio is still pretty miserable, so they got to get that figured out. We'll keep an eye on the actual event, but it looks like they're getting ready to invite Jay Powell up. I'm not sure. This is still just introductory, so that'll give them some time to catch up on this. While we wait for Jerome Powell, so I'll write waiting for Jay Powell, waiting for Jerome Powell. Okay, so we'll wait for Jerome Powell to appear, which will probably be covered live from other angles as well, other sources, so we can always get to a different source. But for right now, let's consider what was really said. In my opinion, from what I'm taking away so far from the speech, we don't really have guidance in any direction, which is kind of what you would expect the Federal Reserve to do. It's like, look, we had good soft inflation data coming in, but now things are coming in a little bit, uncertain in September. Is that going to last? We'll see, and this is a Fed that's very wait and see right now. It's clear restoring price stability would require unwinding of pandemic-related distortions. Okay, this we already know about. Talked a little bit about the history here. We're looking for the new information here. Still no Jay Powell up. That's okay. Waiting for Jay Powell. Many indicators suggest that while conditions remain tight, labor market is gradually cooling. Okay, we want to see that. So that is actually a good thing. Let's go highlight that in green then. Job openings have moved down well from their highs and are now only modestly above pre-pandemic levels. This is good. This is actually positive. Jerome Powell wanted this to be in balance. He wanted a 1-to-1 ratio, now saying only modestly above. That's interesting. That's a softening. That's a softened stance from Jerome Powell to say we're only modestly above those levels. I'd like to see that. That's good. Quits are back to pre-pandemic levels. The same is true. Oh, wow. Look at this. That's a big line right here. Oh, I like this one. Look at this. Quits are back to pre-pandemic levels. The same is true of the wage premium earned by those who change jobs. Wow. That's a game changer right there to go basically say wage inflation is back to what it was. That's a big one. Survey of workers and employees show a return to pre-pandemic levels of tightness. That's good. Again, we don't need the labor market to be untight. We just need it to be back to what it was. That's the tool. Let me check really quick. No, they're still all wobbly. It's very interesting. This is the Federal Reserve's feed directly. Jerome Powell's not speaking right now yet anyway. We're waiting for Jerome Powell to get introduced. And I suspect CNBC or Fox Biz will have a camera there and we'll be able to get that angle. So we'll wait for that. In the meantime, we'll keep going through this document. Document's a pretty big deal. No Jay Powell just yet. Waiting for Jay Powell. Okay, growth. To date, declining inflation has not come at the cost of meaningfully higher employment. This is highly welcomed, of course, but historically unusual. This is the thing. This is the problem with the yield curve, is the yield curve is telling us, like, historically, we should be screwed, but we're not screwed yet. So are we about to get screwed, or like what's going on? That's the, that's the big question right now. They can't even figure out the lighting at this event right now, by the way. Just so you know, there's no Jay. You're not missing Jay Powell yet. Healing of supply chains in conjunction. Oh, my Lord. They're working it out. Okay. Healing of supply chains in conjunction with the rebalancing of demand and labor and supply in the labor market has allowed disinflation without substantially weaker economic activity. This is so unprecedented. I know it's so easy for people to go, oh, Kevin, are you trying to say this time is different? No, Jerome Powell is saying this time is different. Okay. This is literally J-Pow. And it's been said before. It's not to say that, we're not going to have a big dirty crash, but this is basically Jerome Powell saying this time is different / it's certainly weird, right? Unprecedented is the word they're using. Indeed, economic growth has consistently surprised to the upside this year, as most recently seen in strong retail sales data released earlier this week. Right, that is true. Look, he's even incorporating the data we got this week about how strong our economy is. Forecasters generally expect GDP to come in very strong for the third quarter before cooling off in the fourth quarter and next year. Still, the record suggests that a sustainable return to 2% inflation is likely to require a period of below-trend growth. In other words, we haven't yet seen that below-trend growth. No below-trend growth yet. And they're saying we probably need that, right? So we probably need that. What does that translate to? Well, it translates to the famous line that we're tired of hearing. We hear it every freaking day, and it's exhausting and annoying, but it's higher for longer. That's what it translates to. Still no J-Pow, waiting for J-Pow's actual feed to come here. But in the meantime, we're going through to get a little bit more of a feed. Let's see here. I see one of you in the comments who's got a feed as well on it. I will check that link. Thank you so much for that. Yeah, but this host has ended their meeting. Dude, they can't figure it out. They're showing like their desktop right now. It's actually funny. Look at this. I'll show you because it's just kind of embarrassing. So again, we'll wait for a feed. Probably, I suspect CNBC will show it. But look at this. Rip. What do they got here? New tech NDI video monitor, AGA control room, test vid, untitled _01. That's the Federal Reserve's YouTube channel right now. That's actually embarrassing. Okay, so waiting for a better feed somewhere, or either a new feed or something, which we'll get, I'm sure, soon enough. But no J-Pow yet. Anyway, we're waiting for him to come out and actually speak. So going back to what his actual statement is or would be here, presumably, we are okay. Yes, do we have him yet? That's an old one. Hold on. They deleted it. No, they didn't. They're okay. Now they're just back to the building. This is pathetic. This is basically where we're sitting right now. That's all we get. And here's the actual event.
So they did take a modest step down.
Yeah, so you can see they're not really ready yet. Okay, keep looking here. Yeah, that's yields took just a modest step down. Geopolitical tensions are highly elevated and pose important risks to global economic activity. Our institutional role at the Fed is to monitor these for their economic implications, which remain uncertain. Speaking for myself, I found the attack on Israel horrifying, as is the prospect for more loss of innocent life. Yes. Turning to monetary policy, the FOMC has tightened policy substantially over the past 18 months, increasing the Fed funds rate by 525 basis points, basically the fastest historically since the 80s. Decreasing our securities holdings by about $1 trillion. This is true, man. Just look at the repo facility. It's crazy. Then we've got, let's see here. Given the fast pace of tightening, there may still be meaningful tightening in the pipeline. Correct. This is a way of saying the Fed might end up being at peak. My colleagues and I are committed to achieving 2%. We already know that. And to keeping policy restrictive until we're confident that inflation is on path to the objective. So are committed to achieving a stance of policy that is sufficiently restrictive. Okay, the byline that we got from the tape was that they suggested they were at a restrictive level, but we're not sure if it's restrictively restrictive yet. Sufficiently restrictive. Oh, yeah. Additional evidence of persistently above trend growth or that of tightness in the labor market is no longer easing could put further progress on inflation at risk. Could. Notice they're not saying that if you have above trend growth, you will definitely have inflation. This is something that everybody messes up. And it's worth paying attention to. That just because your economy is doing strong doing well does not mean you're going to have inflation. Everybody should remember that we had a strong economy between 2011 and 2020 with no inflation. In fact, we had so little inflation because capitalism and innovation drives inflation down, not up. Innovation and competition brings prices down, not up. Remember that. We had so little inflation. You know how stuck the Fed is on the 2% inflation target now? Well, in the decade before the pandemic, they were thinking about lowering the inflation target from 2% to 1.75. And they still have not brought out the, what's it called yet? The flexible average inflation targeting. They still haven't brought that out, which is crazy. Thank you here. There's a, you know what? Masculine Mindset. Let's go ahead and pin you. Thank you for that. Masculine Mindset here reminding us that the HouseHack fundraise for 2023 ends on the next Fed day that we have coming up, which is November 1st. You can ACH, credit card, debit card, wire, whatever you want. Go to househack.com, read the offering circular and invest in HouseHack. Expect this weekend to start getting some good HouseHack videos as well. We're going to start showing renovation progress on some of the first deals we bought and what we're doing strategically with what we're buying, what we're doing, how we're buying, how we're evaluating. So you'll get to see some really good information. So CNBC picking up protesters. Let me listen. That's actually funny.
Come into place. So I think you're absolutely right to be focused on it. You're 100% right to be focused on the issuance issue, and the Treasury needs to get out in front of this.
Yeah. All right.
Oh, yeah. Listen to this. Powell's speech to the Economic Club of New York has been delayed because climate activists in the audience were trying to do some kind of demonstration. It's a climate insurrection. No way. So they just go turn the lights on. That's funny, actually. Hey, you know what? You can't get mad at the hustle. Like the climate group, they hustle. Like, love them or hate them. They throw themselves on highways and they oil stuff. They're going to mess with the Fed. Like, it's annoying when you're trying to get stuff done, but you can't blame the hustle here. Interesting. Anyway, let's keep going here. Along many other factors, actual and expected changes in the stance of monetary policy affect broader financial conditions. I mean, this is all generic so far. Financial conditions. Oh, what's this? Financial conditions have tightened significantly in recent months. What is that saying? That's translating. They're basically saying, hey, look, yields went up, bro. And long-term bond yields have been an important driving factor. Oh, they actually defined it in the very next live. Exactly. We remain attentive to these developments because persistent changes in financial conditions can have implications for the path of monetary policy. In other words, we might pause. We might be done, bro. Yes, they probably are. Colleagues and I remain resolute in our commitment to returning inflation to 2% over time. A range of uncertainties, both new and old, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched. That's what we don't want. We don't want entrenched inflation. There's no sign of that, and ultimately require more policy tightening to wring more persistent inflation from the economy. Not what we're facing right now. Then we have, hold on a sec.
Right now, we are seeing Jay Powell at the podium. We generally know what he's going to say. We do have his prepared remarks. We're waiting for him to continue his speech. We're going to return back to the New York Economic Club for the Q&A. But for now, I actually want to return back to Steve Leisman. Steve, things have clearly gotten settled in the room. Jay Powell's back at the podium. Right now, looking at the markets, they did inch higher after his comments, but they've eased back just a bit.
Hold on. Try business.
Get more than just mobile.
Fox Business isn't covering it either. Why? I mean, it's because they released the statement.
Yeah, I'll address that real quickly, but let me talk about the Powell is kind of damned if he does, damned if he doesn't on climate change. If he did a little bit in terms of saying we were going to be not really making it official, but just looking at the climate risk in different banks' portfolios, and he got hammered by the Republican side, and now he's getting hammered from the other side for apparently not doing enough. This idea that the Fed
There's no feed on the Fed page that's actually live. It's just CNBC that has it, but they're not playing as audio until they get to Q&A.
It was helping or hurting with climate change. Of course, the Republican side pilloried the Fed for her for saying that. So let me get to this issue, though, about the muddled outlook. If you listen to Bob Pisani, who does a wonderful job of breaking down market views, Frank, it is simply muddled. It is very muddled right here. We keep putting forward.
Here we go.
March of 2022, it was clear that restoring price stability would require both the unwinding of pandemic-related distortions to supply and demand, and also restrictive monetary policy to cool strong demand and give supply time to catch up. These forces are now working together to bring inflation down. After peaking at 7.1% in June 2022, 12-month headline PCE inflation is estimated at 3.5% through September. Core PCE inflation, which omits the volatile food and energy components, provides a better indicator of where inflation is heading. And 12-month core PCE inflation peaked at 5.6% in February 2022 and is estimated at 3.7% through September. So clear progress there. Inflation readings turned lower over the summer, a very favorable development. The September inflation data continued that downward trend, but were somewhat less encouraging. And shorter-term measures of core inflation over the most recent 3 and 6 months are now running below 3%. But these shorter-term measures are often volatile. And in any case, inflation is still too high.
Good.
And a few months of good data
He's discounting
are only
that
the
September
beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We cannot yet know how long these lower readings will persist or where inflation will settle over coming quarters. While the path is likely to be bumpy and to take some time, my colleagues and I are united in our commitment to bring down inflation sustainably to 2%. In the labor market, strong job creation has met a welcome increase in the supply of workers, due both to higher participation and to a rebound of immigration to pre-pandemic levels. Many indicators suggest that while conditions remain tight, the labor market is gradually cooling. Job openings have moved down well below their highs and are now only modestly above pre-pandemic levels. Quits are back to pre-pandemic levels as well, and the same is true of the wage premium earned by those who change jobs. Surveys of workers and employers show a return to pre-pandemic levels of tightness, and indicators of wage growth show a gradual decline toward levels that would be consistent with 2% inflation over time. To date, declining inflation has not come at the cost of meaningfully higher unemployment, a highly welcome development, but also a historically unusual one. Healing of supply chains, in conjunction with the rebalancing of demand and supply in the labor market, has allowed disinflation without substantially weaker economic activity. Indeed, economic growth has consistently surprised to the upside this year, as most recently seen in the strong retail sales data released earlier this week. Forecasters generally expect GDP to come in very strong for the third quarter before cooling off in the fourth quarter and next year. Still, the record suggests that a sustainable return to our 2% inflation goal is likely to require a period of below-trend growth and some further softening in labor market conditions. Geopolitical tensions are highly elevated and pose important risks to global economic activity. Of course, our institutional role at the Fed is to monitor these developments for their economic implications, which remain highly uncertain. But I will also say, speaking for myself personally, I found the attack on Israel horrifying, as is the prospect for more loss of innocent lives. Turning to monetary policy, the FOMC has tightened policy substantially over the past 18 months, increasing the federal funds rate by 525 basis points at a historically fast pace and decreasing our securities holdings by roughly $1 trillion. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation. Given the fast pace of the tightening, there may still be meaningful tightening in the pipeline. My colleagues and I are committed to achieving a stance of policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of policy. Along with many other factors, actual and expected changes in the stance of monetary policy affect broader financial conditions, which in turn affect economic activity, employment, and inflation. Financial conditions have tightened significantly in recent months, and longer-term bond yields have been an important driving factor in this tightening. We remain attentive to these developments because persistent changes in financial conditions can have implications for the path of monetary policy. My colleagues and I remain resolute in our commitment to returning inflation to 2% over time. A range of uncertainties, both old ones and new ones, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above-target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. Thank you. I look forward to our conversation, David.
All right. Do some Q&A. The Q&A part's going to be a good part. Let's see. It's supposed to be Q&A. Where are you going? Oh, good.
Thank you
sit
very
down.
much, Chair Powell, for being with us today, for the remarks, and for having a bit of a conversation here. Really appreciate it. It strikes me it's a particularly propitious time, given everything that's going on in the world and in the economy. There's a lot to talk about, a lot to discuss. Let me start with something you just referred to, which is the surprise to the upside in the economic data, despite, as you termed it, I think, historically fast pace of growth. Are you surprised at how resilient the United States economy is? Just today, we got jobless claims numbers, surprised because they were low. We got the retail sales numbers you mentioned. We got industrial production. Across the board, it seems like a very strong economy, despite all you've done to try to slow it down.
Yes, so we certainly have a very resilient economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with first high nominal wages, and then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, you know, it really is a story of much stronger demand. There may be some ways in which the economy is less affected by interest rates. It's hard to know precisely, but for example, many companies, any company with bond market access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing or the housing sector has been very affected by higher rates, as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house, quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough. And again, it's all happening in a context of very strong demand.
We've heard other people speculate maybe the terming out of debt, as you say, both corporate debt and household debt, may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. As I mentioned, we are seeing the effects where we expect to see them, which is interest-sensitive spending and also asset prices to some extent, and the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control, they come to us, and we conduct policy always to achieve maximum employment and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down, these are the elements that we want to see that to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this without a big increase in unemployment.
Yeah, he's
How
right.
much effect thus far has the Fed had? We all have memorized now long and variable lags. How long and how variable, and where are you in that process? Are you at the 25% point, the 50% in terms of seeing it in the effect in the real economy?
So there's no precision in the in our understanding of how long lags are. One thing that has changed in the modern era is that markets now, over the course of the last 30 years, central banks have decided, instead of being secretive, to be very transparent. And what that has meant is that markets move actually well in anticipation, well before our policy moves. So the transmission from policy moves to financial conditions actually happens before the moves now, whereas that was not the case 50 years ago when Milton Friedman coined the phrase long and variable lags. So, but now you have financial conditions changing, and the question is, how does it affect the economy? The standard channels are asset prices, interest-sensitive spending, and the exchange rate, for example. And we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has been stronger, and that's by far the largest part of the economy.
In order to conduct monetary policy effectively, do you need at least a hypothesis about how much has already hit the economy? Because it's hard to know how much more you need to do if you don't know how far you've come.
So on lags, I think if you think back, it's been a year since the last 75 basis point hike we did. It was at the November meeting in 2022. The first one was in June, so it's more than a year. So we should be seeing the effects. By the way, they don't all just arrive on one day. They arrive and then they're thought to peak and then to diminish. So there's a lot of uncertainty around lags. And one of the reasons why we have slowed down significantly this year is to give monetary policy time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our eyes and a little bit of risk management and patience in slowing down the pace to make sure that we are seeing the full effects. And I think, again, that's part of why we've slowed down this year. We went very quickly in 2022 to catch up to where we needed to be, and now we're moving carefully with these decisions.
So when you spoke back in August of 2020 and sort of laid out the revisions to the framework, as it were, you said that in terms of anticipated growth, the sort of consensus had gone from something like 2.5 to 1.8%, I think were the numbers you laid out in that. Where are you now? Where's the Fed? Where are you? And what you think basically the long run growth is? Long
run potential growth is not something that moves around a lot over time, but my own guess is it's around 2%. I think that the standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable standard longer term estimates of hours worked growth and productivity, which is just output per hour, productivity growth, you get something around 2%, and that's higher than most other advanced economies.
As you look at it, do you see historical precedents for having a growing economy with high rates over a long period of time? I mean, as you look back, I mean, is it like the late 90s, for example? What analogies do you draw as you try to determine what this might be doing to the economy over the longer term?
So that's really a question about what the level of rates will be going forward, what the neutral level will be. And I think it's very hard to know confidently what the answer to that will be in 5 years. Some of the reasons why rates were low for the last 25 years were just the aging of the global population and globalization, and so lots of savings and relatively with an aging population, savings greater than investment, so rates are lower, and productivity was low. So all of those led to low interest rates. So what has changed with the pandemic? You might see less effects from globalization. Certainly demographics, the aging of the global population has not changed. I mean, this is a discussion we're having on an ongoing basis. It doesn't really affect current policy, but where will rates settle out? What will be a normal rate? So if a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher frequently. Are we going back to that? I really don't know. I wouldn't want to speculate. I mean, my guess is it'll be somewhere in the middle, but I don't know. I mean, I think we can say this now. The effective lower bound is not an issue. We were very concerned about that. Right now, we're very far from the effective lower bound, and the economy's handling it just fine. But that's because we're at a time of really elevated demand coming out of the pandemic as we reopened with fiscal stimulus and monetary stimulus. We have very strong demand in the United States. Hard to know what the economy will want in the way of interest rates when 5 years from now, when all of the effects of the pandemic are behind us.
You mentioned the long-term equilibrium rate, which you talked about again back in Jackson Hole in August of 2020. Back then you said you thought the sort of consensus had come down. I think it was from like 4.25% to 2.5%. Where is it today?
So I think by any reckoning, long-term interest rates and the neutral interest rate came down steadily over the course of several decades. So where is it today? I don't know. We're finding it basically. The idea was I think the median indication of what the real neutral rate was around 50 basis points before the pandemic. It may have risen in the near term. The real question that matters, though, is will it rise in the long term? And that we don't know.
But do you need to know it in order to conduct monetary policy? I mean, you must have to have at least a theory. I mean, I'm not saying you have to be right about it, but you have to have a hypothesis, don't you? As you look at the data, you have to put the data through some sort of theory.
So we all write down our estimates of the longer run neutral rate every quarter in the summary of economic projections. And that's based on models. It's based on also looking out the window and including lags, thinking how are our current rates affecting the economy. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though. But we have models for everything. We have formulas for everything. Ultimately, as a practitioner, we have to be focused on what the economy is telling us, even taking lags into account. What's it telling us? Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that policy is too tight right now. And we're at 5.25% to 5.5%.
Do you think we're entering into a new phase in monetary policy? We had the Volcker disinflation, I think you referred to it as, and then we had sort of inflation targeting for a time. There was concern about secular stagnation. We were pushing the zero bound, as you said. We were concerned about that. And then we had the pandemic, and we had the real problem with inflation. What's the next phase look like? How would you describe it?
What we've been through is, in all of the advanced economies around the world, was a period where the effective lower bound, the proximity of interest rates, risk-free interest rates to the effective lower bound, which is zero or a little bit less, was a big problem for monetary policy. And just rates came down and down and down. And the problem is, if rates are going to be close to zero in good times, then how do you cut? And so have central banks lost the power of their most important tool, which is interest rates? This was a subject of a vast literature in monetary policy research for 20 years. And the most common answer was some kind of a makeup strategy. So you would credibly promise to run inflation a little bit hot and above 2%, and that would anchor inflation at 2% to counter the times when it was below. So that was a very serious problem, which filled books worth of research. Then comes the pandemic, then comes the response to the pandemic, and then comes the pandemic inflation, not just in the United States, but everywhere. The question is that a secular change, or are these factors that brought us to that place, are they still out there waiting to come back? And, books are written on this subject now. You can argue that, and
just, quickly, when they talk about effective lower bound, they're talking about 0%. 0% interest rates. And there was a fear that, what if we have to go negative? That was before, right? Now he's like, oh, we have room to cut. That lets us support the economy if something breaks.
Be characterized by more supply shocks and things like that, and therefore more inflationary pressure. Yeah. So are we going into such a, I don't know. I mean, all I can tell you, I think it's unknowable, and, great theorists and researchers have different views on this. It's not something you can settle in advance. We'll have to see. I think our issue is right now trying to achieve a sufficiently restrictive stance of policy to bring inflation down to 2% over time. That's what we're really focused on.
Whenever any of us go, particularly institutions, go through tumultuous times, and goodness knows you've been through a tumultuous time, we look back and think, okay, what did we learn? So an after-action report. Look at the pandemic and the pandemic inflation. What would you say you learned in terms of macroeconomics, in terms of the economy, from that experience?
So hindsight is always a wonderful thing, right? I think the fair way to judge the actions that were taken is to put yourself in the place of legislators and policy, other and central bankers around the world. And there was no playbook. We hadn't seen a global economic shutdown. People were thinking that the pandemic might kill a whole lot of people and that we wouldn't have a vaccine for 5 years. We might not have an economy for 5 years. So these things were all very possible in March of 2020. And so we pulled out all the stops, and Congress pulled out all the stops. With the benefit of hindsight, could we have done a little bit less and had a little bit of inflation? I guess we could. But I think if you look overall at the performance of the U.S. economy, our economy is the strongest. We're actually also making the most progress on inflation, but we certainly have the strongest growth. We're back to prior growth trend, not just level of where we were. We're actually back to the prior trend. The labor market, the last time we had this many consecutive months of unemployment below 4% was in the late 1960s. So it's more than 50 years ago. So our economy is doing very well from all of that. But if you had perfect hindsight, you might not have had as much inflation if we'd done less. Although other countries who didn't do as much as we did also had substantial inflation problems.
I think my question was just a little bit different. It's not so much of assigning blame or saying, did somebody make a mistake, as are there things that going forward would change the way you conduct monetary policy that you learned from that maybe nobody had reason to know at the time, but it was an experience you went through?
Well, we were in a time of a very long time, in a reasonably long time, of disinflationary forces. And I think everybody's instinct had been attuned to risks coming from this direction, which is too low inflation. And so what this has taught us is that now that period is over, and we now have probably going forward a more balanced set of risks where high inflation and low inflation are both risks. In fact, right now the risk is still high inflation, but I'm assuming once we get back to 2%, we won't have that. But we've certainly learned that, and events are the possible range of events is so much wider than what we think it is on any given day, right? The tails are so wide, and it's just not human nature to constantly be thinking about things that are way out in the tail, but they happen in financial markets and in economies. They happen far more regularly than they should.
I suspect every person in this room is well aware of what's going on with yields with bonds. It's been a big story, particularly in the longer end of the curve. What is your understanding of what is going on in the bond market and why those yields are going up, particularly again at the longer end of the curve?
So it's really two questions. One is why is it happening, and the other is why does it matter for policy? And so I would say on the why is it happening question, I think it's appropriate to have a little bit of humility. It's always hard to say exactly what's going on with longer term yields, but this is what I think we can say. First, what it's not. It's not apparently about expectations of higher inflation, and it's also not mainly about shorter-term policy moves, so Fed funds moves over the next year or two. Really, if you can look at the 2-year, for example, and 2 years moved up a little bit since September, but really the move is in longer-run bonds. So it's really happening in term premiums, which is the compensation for holding longer-run securities, and not principally a function of the market looking at near-term fund rate. I think a few other ideas about, there are many candidate ideas, and many people feeling their priors have been confirmed by this event, I'll say, as well. But so one would be just that markets and analysts are seeing the resilience of the economy to high interest rates, and they're revising their view about the overall strength of the economy and thinking even longer term, this may require higher rates. That could be part of it. There may be a heightened focus on fiscal deficits. That could be part of it. QT could be part of it. Another one you hear very often is the changing correlation between bonds and equities. If we are going forward into a world of more supply shocks rather than demand shocks, that could make bonds a less attractive hedge to equities, and therefore you need to be paid more to own bonds, and therefore the term premium goes up. So all of those are possible ideas. Then the question is, does it matter for us as long as I'm talking about this? So the way I think about it is, we change our policy. Actual and expected changes in our policy affect financial conditions, and persistent changes in financial conditions affect economic activity, hiring, and inflation. So one question is, are we seeing the longer run bonds, are they the increases in rates? Are we seeing those come through in financial conditions in a persistent way? And I think if you look at financial conditions indexes, the answer so far would be yes, you are. Persistence, it will be a matter of just seeing with our own eyes, but certainly they're coming. If you look at financial conditions indexes, they're showing tightening, and it's a lot because of longer rates. Then the question is it endogenous? And is it just because the market expects us to take things, to take further actions to tighten monetary policy, in which case if you have to follow through. But that doesn't seem to be the case. It doesn't seem to be principally about expectations of us doing more. It seems that the other factors are the more prominent ones.
Another question is,
bottom line though, that means it probably does over time. It makes sense. It's something that we'll be looking at.
well, that's the question I was asking, is over time. From what you understand right now, do you think this is a temporary phenomenon, or do you think there are structural factors, whatever they are, and we can talk about what they might be, that would really, this is the future that we're looking at now?
Well, so of the factors I just listed, some of them are shorter term, some of them are longer term, and some of them could be either. So for example, concerns over fiscal deficits, that could be a longer term factor. The change in correlations between stocks and bonds could be a longer term. I don't think we know. I think, basically bond prices are set by supply and demand. The supply of treasuries is a known thing, but demand can be affected by any and all of these theories, and also just by sentiment too, which is hard to characterize. So, markets have been volatile. They've been longer. You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. But for now, it looks, it's clearly a tightening in financial conditions, and so we'll be watching it carefully.
Talking about the fiscal side, and you've been very careful repeatedly to say you want to stay in your lane. You're not responsible for fiscal issues. At the same time, you have to take into account. And it looks like the United States is going to have to borrow a fair amount of money. By the way, other countries are as well around the world. We have a big supply of treasuries coming on board. To what extent do you think that is a longer term issue? And let me tie it back to something you referred to in your remarks, actually. When we see geopolitical conflict around the world, like in Israel, like in Ukraine, some of the buildup with respect to China, the defense spending is going to be elevated for the United States and for other countries. Do you take that into account in figuring monetary policy? Because it may well mean that we're borrowing a lot more money than we have in the past.
So we, of course, see the same things that everyone else does. I just came back from IMF meetings this weekend, and there's a lot of talk of the very large resource demands that organizations like the IMF and of course countries are facing, and the need for substantial amounts of revenue. You mentioned military. There's also dealing with climate change and things like that. So there's a lot of that. We don't, as you mentioned, we don't comment on fiscal policy. Actually, the fiscal authorities have oversight over us, and not the other way around. So we stay away from that. So I would say everyone knows that it's not a secret, and about all I can say is we know that we're on an unsustainable path fiscally. It's not that the level of the debt is unsustainable. It's not. It's that the path we're on is unsustainable, and we'll have to get off that path sooner rather than later. It's not really something, though, that affects a monetary policy decision about how much we raise rates in the next 6 months. It's not going to be driven by. If there was some vast new fiscal policy that were about to be enacted, and then that would have an effect on the models and have an effect on projections, and indirectly that would affect us. But we would not be in a position of responding directly to fiscal policy.
When we talk about the treasury market, obviously there's buying and selling, and the United States government is issuing a lot of treasuries. There's also a question of who's buying, and we now have one buyer who stepped out of the marketplace, namely the Fed, which is a big buyer. At the same time, we're getting reports that maybe some of the overseas buyers may be pulling back as well. How do you take that into account in assessing where we're going with long-term bond yields?
So actually, I think buying by overseas entities has actually been pretty robust this year. So there have been some small changes, but I think by and large, they've been buying, robustly. Again, we look at the broad financial conditions. We look at interest rates, other asset prices. That's what we look at. We don't focus on fiscal policy. We wouldn't change monetary policy because of, for example, because we think that the U.S. is on an unsustainable path. Everyone knows that. We're just going to do monetary policy to achieve maximum employment and stable prices. And that's how we think about it.
I'm curious, though, one of the things you're most concerned about is the real economy, what's going on in the real economy. You distinguish yourself from some of your predecessors in that you have a significant exposure to the private sector, not just the public sector, academics. As you talk to CEOs, people in business, what are you hearing about the cost of capital? Because these bond prices are really affecting cost of capital for the first time in a while. There was a long time the cost of capital felt like it was almost zero. And business changes an awful lot when the price of money goes up.
I talked to several people this week who run companies, and they each said that the economy remains strong and that they don't see the consumer. You see, there's some areas where spending is softening, but overall, look at the retail sales number.
Yep.
Consumer is strong. Volume is not going up very much, but companies are profitable. Now if you get to where I think the cost of capital would really matter would be for smaller companies and early stage companies, and that really does matter. So we don't have a lot of tools. We have interest rates, and they're far from perfect. It's famously a blunt tool, but it's what we have to get inflation down, and really the world counts on us to deliver low and stable inflation. That's what we have to do. And at a time like this, we know that we're having negative effects on, we had the home builders in this week. It's a very tough time in the whole home building industry. And we know that. But ultimately, what we want to get back to is a long period of price stability. That's the best thing we can provide. And that policymakers and businesses and everyone and people can just lead their lives not worrying about inflation. This is what we can deliver. It's what we have to deliver. And this is the time. Our independence is not for times when we're really popular. It's for when we're doing something that really the public counts on us to do, notwithstanding that it's challenging and difficult. And higher interest rates are difficult for everybody.
You have not wavered from your commitment to 2%. You did it again today, 2%. No question about it. There are those who suggested, including some colleagues in the Fed, that maybe the bond market is doing part of your job for you. Is that the way you see it?
Look, I would say it this way. The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect that they're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works. So again, in principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case, actually. I don't think it's the case. It doesn't seem to me that's where analysis leads you. Then sure, that's a tightening. That's exactly what we're trying to achieve.
And therefore, it seems like almost arithmetic. It must reduce some of the impetus for you to continue to raise rates.
At the margin, it could. I mean, I think that remains to be seen. And by the way, I'm not blessing any particular level of longer-term rates, but just in principle, that's right.
So let's talk about the labor market. You referred to that in your remarks as well. And as you say, vacancies have come down some, although they still are pretty elevated, if I'm not mistaken. Quits have actually gone up some. It seems to be a tight labor market. What do you make of what's going on in the labor market right now?
Labor market has been extraordinarily strong. So what happened in the pandemic was we had a negative labor supply shock, is one way to think about it. So a whole lot of people left the labor market when the pandemic happened and then didn't come back. And so when the economy reopened and everybody, there was revenge travel and revenge everything, very strong demand, and there just weren't the people. So you had 2 job openings for every person actively seeking employment. We've never been anywhere near close to that. There was panic and wages and bonuses, and particularly in things like in-person services where people had not gotten big wage increases and didn't want to come back to work. So that's where we were. So since then, there are very many signs that the labor market is getting back into balance. And I talked about some of that in my remarks. Surveys of work, we survey businesses. We don't do it, but other people survey businesses and say, are workers plentiful? And that measure was no, but now it's back to pre-pandemic levels. You survey workers, are jobs plentiful? And that was at an all-time high, and now it's still high, but back. So wage increases are coming back down to more normal levels. Job openings are down from 2 to 1.4. They were at 1.2 in the very tight labor market of 2019. By the work week, by so many measures, the labor market is gradually cooling. And part of that is this, all through 2022, we thought we were going to get more labor supply, and we didn't. And I personally thought, well, I guess we won't get any. And then we've gotten a substantial amount this year. The female labor force participation is in prime age workers is at an all-time high, which has to be related in some way to work from home. But labor force participation increased, immigration increased, and now you see that in the overall cooling of the labor market. So even though job creation is still very high, there are the workers to fill those jobs. And again, businesses will tell you that it's very different. It's still a very tight labor market, but it's loosening.
Coming back to your goal of 2% inflation, what have you learned from this experience about the relationship between inflation and labor? I mean, there's a lot of talk about a Phillips curve, whether it still applies, whether it's weaker, what is it? What's your hypothesis right now with the relationship between inflation and labor market?
Well, let me tell you what it was before. So one of my favorite charts is just the slope of the Phillips curve over 40 years. And so it shows the relationship between unemployment and inflation. If you go back to the high inflation of the 70s, there was a very tight relationship. And that relationships went down and down and down to the effect where the Phillips curve, there was almost no relationship, meaning the Phillips curve was very, very flat. Now, actually, if you just ignore cause and just look at the data, it will tell you that the relationship is back. Do we really think that's a sustainable thing? I don't know. What happened, though, was that people came to seriously expect 2% inflation, something like 2% inflation. And if people expect that, if companies expect it and workers expect it and you expect that in your shopping, then that's what'll happen in a way. And that's what happened. So
that's the manipulation.
Markets, we didn't have high inflation. I was at the Fed since 2012 as unemployment went from 6 to 5 to 4 into the 3s for the first time. And the models were all saying that we should be seeing some inflation, and we never really saw 2% inflation on a sustained basis during that era. So we learned that the Phillips curve was really flat. Some pronounced it dead. Now, I don't think most of the inflation we're seeing at all is from the Phillips curve, though. I think it was built really the collision of very strong demand, really strong demand with constrained supply. Cars being a great example. Many people wanted cars, didn't want to ride public transportation, wanted to move to the suburbs. Unlimited demand for cars. Interest rates are low. Yet we couldn't get semiconductors, so there are no more cars. Car production went down. How do you solve that problem? Prices just go way, way up for cars. That's how you clear the market. So that's a classic example of what happened here. It really wasn't about the Phillips curve. It was more about constrained supply and demand more broadly, especially for goods at the beginning.
Let's turn to another responsibility of yours, which is the banking system. Last March, we had something of a scare because of, I guess, interest rate risk with Silicon Valley Bank and then some others. Are we through that now? Where are we in that process? Are you resting easy?
So what you pay us for is not to rest easy. We don't do that. But I would say where we are is this, though. Things have certainly settled down, we see the funding markets is fine. We see, and we paid a lot of attention to banks that looked anything like the banks that had the problems, and made sure that they had credible liquidity plans and plenty of liquidity and all of that. And so I think all of that has worked. And we set up this facility that's available for banks to borrow. And so all of that has led to a real settling down. But, our job is to be on the case, and, we're still on the case, and we'll keep after that. Banks are generally very well capitalized and highly liquid in our country. Banks are strong. We benefit from all those years of reform under Dodd-Frank and Basel III that we went through, with former Governor Tarullo,
right.
and many others. And so we benefit from a very strong, well-capitalized banking system that's much better at managing its risks than the one that entered the global financial crisis.
Very well capitalized, but you want some more. This is
You're talking
the
about
proposal.
the Basel III proposal, which is, it's a rule that's out for comment, so there's not a lot I can say, but we do expect a lot of comment, and we do expect to take those comments very seriously.
Talk about the commercial real estate. There are some concerns out there in the marketplace, what's going on, because obviously there's a repricing that comes with your increased rates. It's thought that there's some real estate out there that is not worth the money that was originally financed with it. How concerned should we be about that as something lurking out there that could really affect the system overall, not just the people invested?
So there's work from home, and that's affecting downtown real estate in a lot of big cities, and higher rates as well, as you point out. So this is an issue that we pay a great deal of very careful attention to. Commercial real estate is not a principal risk or a major risk for the very largest banks. It is much more for regional and really the smaller banks have proportionally a much larger exposure to real estate, so commercial real estate. So what we've done is the supervisors are in there looking at real estate portfolios. They're working with banks to make sure that they have plans to deal with the problems they have in their portfolio. These problems evolve over time. They don't land with great suddenness like a market event. And so we're working with all of the bank regulators are working with banks that have concentrations of troubled real estate to work it out. There will be losses for sure. You can drive down through most downtowns, in many downtowns anyway, and see buildings that are empty and things like that. But we're working through it, and we're on that case, and don't see it as as presenting much broader problems. But our job is to make sure that it doesn't.
As you mentioned, regional banks are where a lot of people focus on this. As you conceptualize the banking system, what is the role of the regional banks? We have the super big banks that don't look like they're going anywhere. And we've got the community banks, the smaller banks that we understand are critical, particularly for small businesses and local context. But what about the regional banks? How much pressure is on them? And what would the damage be to the system if, in fact, there was more consolidation with some of the big banks?
I think the regional banks are very important, extremely important. We have 4,500 banks, which is a lot more than any other country per capita or per dollar of GDP. But we have, our GSIBs, the largest banks, are the leading banks in the world in profitability and in their success in their business. We have community banks who deal in smaller communities. But we also have these great regionals, and I think they do a great business with many companies. And I do think their business model is under pressure, and I would not like to see us add to that by treating them exactly like GSIBs. I think they don't need exactly the same attention that a GSIB gets. So, but I would say I personally think, and I think we at the Fed strongly think that the regionals and the smaller regionals are an enormously important part of our banking system.
Okay, you've been very generous with your time. Really appreciate it. I have one last question. Are you having a good time? And if so, why?
Now or
no. I assume this wasn't that pleasant, but in general, you're enjoying your job.
I would say this. First of all, it's an incredible honor to do this job. And every day I do it, I feel so fortunate and so lucky and blessed to be entrusted with this. And, all I want to do is do the best job I can for the public.
We're going to do a summary here in a second.
And yes, there's a lot that's enjoyable about it, but mostly it's just so important to get it right, and that's what we're trying to do.
Thank you so much, Chair Powell. It's really good of you.
Thanks a lot.
All right, let's do a summary here. There's a lot here to unpackage. Let's try to just keep it as simple as possible. Stand by. All right, here we go. Okay. And here. Got it. Okay, great. All right. Well, Jerome Powell just finished speaking, and wow, there's a lot to unpackage. Let's get right into it. So Jerome Powell said something delicious and juicy. He says, look, the whole point of higher rates is to tighten financial conditions. He says, quote, that's literally how it works. And so what's interesting is you've noticed Jerome Powell and the Fed been a little bit more fussy and maybe hawkish, and look at what's happened to financial conditions. This is the Goldman Sachs Financial Conditions Index. The Federal Reserve started hiking right around this region right here. You notice that these financial conditions really started relaxing, and actually even relaxed during the banking crisis. A little bit of a spike there, but then a relaxation again. We are almost at the tightest financial conditions now, though, that we've seen following bond yields now at almost 5% for the 10-year Treasury, at the geopolitical risks that we're seeing, the lack of a House Speaker that we're seeing. Right now, the 10-year is sitting at 4.96% after that presentation. That's up slightly. Oil's up slightly again at almost $92. These are some expensive issues that people are very concerned about, and rightfully so. What's interesting, though, is Jerome Powell says he talks to businesses regularly, and he finds that the economy is strong. The consumer is strong. Where there's pain is potentially amongst smaller, more cash-strapped companies, early-stage companies that don't have cash that they can invest in treasury bonds. For example, at HouseHack, we have money sitting in money markets or treasury bonds earning like 5 to 6%. It's crazy. It's amazing. Deadline, by the way, for investing in HouseHack is November 1st. That's the other Fed day coming up. But Jerome says, look, many forecasters were saying we'd be in a recession, and here we are. Inflation's going away, and we're not in recession. And he's not actually wrong. If I were Jerome Powell, I'd be cheering right now. I'd be like, bro, we basically didn't break anything. We still have under 4% employment. Jerome Powell's talking about how unemployment has not been under 4% for this many months in a row since the late 1960s. That's over 50 years, over half a century lows of employment that we're facing right now. Yet the economy is still moving and still chugging along above trend. Now, Jerome Powell thinks we might have to get the economy under trend to actually, and he says we're at trend right now with economic growth. He thinks we might have to get the economy below trend to actually reiterate we're not stopping until we get to 2%. But overall, so far, a lot of wins. What about the banking crisis? People say, well, of course. They created the money printer banking facility for that, which basically said, don't worry, if treasury yields go up and your bond values go down, fear not, we'll still lend you money assuming those treasury bonds are worth 100%, because we could always just take them and wait till maturity. We got time. That basically overnight solved the banking crisis. Really, really incredible. Now, what I really want you to think about that he said, which was, in my opinion, there were two game changers here, okay? One that I'm about to talk about, and the second one that Nick T pointed out, which I also noticed in his speech. The first one is that he actually showed us his hand. He said something that a lot of people missed. It just went right over people's head, below their knees. He said it really clearly. He said, look, if people seriously expect that we won't stop until we get to 2% inflation, then we'll get to 2% inflation. Then he said, if people didn't believe us, we would never get there. And I'm paraphrasing now, but he basically said, if we came out and said we're done and we're not trying anymore to get to 2%, then bond yields would plummet, bonds would rally, and financial conditions would loosen really rapidly. And then we wouldn't get to 2%. So basically, even though inflation is going away, and in his commentary, in his prepared speech, his prepared remarks, he basically suggested there's a lot of volatile data. We have inflation coming down. Inflation was really great this summer. We had a little bit of a pop in September, but that's probably just volatile data. And we don't really have to be that heavily concerned about that. We have to keep putting on the face of strength until inflation's basically meaningfully on its way to 2%. Because as soon as we say we're done, bond yields plummet. And that makes it harder to get to 2% in the first place. So in other words, even though we're trending towards 2% and everything's going great, we still have to pretend like everything is bad, because if we stop pretending, then we'll unwind the progress we're making. It's like a topsy-turvy world, but Jerome Powell is so clear about that. He is so crystal clear about that. There's no secret here. He's being very blunt and blatant about that. But everybody wants to forget that. There's this fear that there's actually still an inflation problem. There's not. And every inflation report that comes out, oh my gosh, there's a real inflation problem. There's not. Even in today's conference, Jerome Powell is very clear. Look, what caused inflation was a massive capability of demand coming at the same time as a supply chain shock driven by COVID. And even in countries that didn't print as much money as we did, they also experienced massive inflation because of these supply chain changes with high demand. But that's not what we have going forward. So he says we're basically on the trend to maybe even going below 2% inflation, just like where we were in 2012 through 2019. We could go back to that. And if something breaks, we're not up against the effective lower bound. That's a big deal. The effective lower bound, the ELB, is 0% rates. It's basically a way of saying if you're at 0 and something breaks, how do you cut? You can't cut. But we're at 5.25%. You have a lot of room to cut if something actually breaks. The second big game changer was what he talked about labor. This is something that Nick T from the Wall Street Journal pointed out as well. And as I went through the transcript the first time, I actually wrote wow next to it twice. I'm going to read you this because it's the most important part out of the actual prepared remarks. In the labor market, strong job creation has been met with a welcomed increase of a supply of workers due to higher participation and a rebound of immigration. Many indicators suggest, while conditions remain tight, the labor market is cooling. Good. That means less of a wage price spiral. Perfect. Or no wage price spiral. Job openings have moved down from their highs and are only modestly above pre-pandemic levels. That's a wow right there. In the past, he used to say, we want 1-to-1. Now he's like, we're only modestly higher on the jolts right now. This isn't that bad. We don't need to go to 1-to-1. He's basically undoing what he previously said. He's flip-flopping. He's like, 1-to-1's not that important. We're okay being modestly above. Otherwise, he wouldn't say it's modestly above. He would say there's still progress to be made. This is good. That's a flip-flop from the Fed. What's another one? The one that Nick T pointed out has to do with inflation. And here it is. Quits are back to pre-pandemic levels. The same is true of the wage premium earned by those who change jobs. Surveys of workers and employers show a return to pre-pandemic levels of tightness. In other words, remember how Jerome Powell is so worried about inflation coming from that third part? There are three parts: goods, housing, and then services x housing. Okay? Housing we know is coming down. Goods inflation is coming down. Put those off the shelf. What do you have left? Services x housing. Okay. What drives services inflation x housing? First of all, what is that? It's the person who cleans your teeth. It's the person who cleans your house. It's the person who does your tax returns, your lawyer, your funeral parlor. It's your veterinarian. It's your doctor. These are services. Okay. Services x housing. Those prices go up when wages go up unsustainably. Jerome Powell basically here is saying wages are going back to what you would expect or would have expected pre-pandemic. What inflation did we have pre-pandemic? 1.75%. We had below trend inflation. Right now he's flipping. He's basically saying, look, we're not really, like, between you and me, we're not really getting inflation anymore. Like, the inflation problem's done. Now we have to be sure it's dead. And the way we're going to be sure it's dead is by pretending we still have to be at these high rates. If something breaks, we can cut. But until then, we'll just sit here at these restrictive levels. And we don't think these rates are too high because the economy is still doing well. But we're just going to sit here until we get to the lower rates, because as soon as we signal that we're going to U-turn, bond yields will plummet off a cliff. And that'll loosen financial conditions, which could lead to grandma and grandpa going back on margin into Robinhood and YOLOing stocks. And then you get another bubble. That's what they're trying to prevent. So this is a manipulation. And he's being very transparent about it. He's like bluntly telling the economy, hey, I don't believe you that you are going to sustain 2% inflation. So I'm just going to ream you until inflation is 2%. So what does that practically mean? Well, practically means if you're investing in stocks, you can't be a little weenie baby. You're going to have to buckle up and realize it's still going to take time for stocks to moon and go to new highs. That's going to take time, and that's okay. That gives you years potentially here to DCA and increase your position in stocks that you think will matter in the long term, 5-10 years out. I'm not here to advocate trading in and out every single day. Just because Elon's a little bitch doesn't mean we need to dump Tesla stock. Although some people are dumping Tesla stock because they're like, damn, he really a big problem. But anyway, we talk about that in a separate video. Point is, long term, Jerome Powell's pretty happy. Jerome Powell's winning. Jerome Powell is setting up for his statue because he is winning. And he knows he's winning. He just doesn't want to risk giving up. It's kind of the way I think about it is, imagine you're on a marathon run, okay? And you're winning. You're in first place. You don't want to be the guy who slows down right at the end before the finish line, puts your hands up and goes, yeah, I'm winning. And then the second place person runs past you. It's happened plenty of times in sports, and it can happen with the economy as well. Jerome Powell's in first place. He knows he's winning, and he doesn't want to F it up. What else did he say? A little bit of talk about the Phillips curve. Big deal. It's flatter than you would expect. He talked a little bit about how he felt in 2012 when everybody's like, we're going to have inflation. And this is actually funny. He's like, oh, everybody in 2012 is like, there's going to be so much inflation. And he's like, bro, there's no inflation. And then inflation's low for like 8 years thereafter. Like, he's like so clearly telling you the roadmap for the long run. Again, short term sucks. Long run, he's like very clear here. This is actually very transparent. Banking crisis, we have a facility for it. No major risks to banks from a commercial real estate shock. Could there be more shocks? Of course. Interest rate spending sectors are starting to show pain. That's housing, that's cars, that's Elon Musk. But we still have strong demand, strong savings, higher than we expected. Let's see here. 5-year break even, by the way, up again, 2.4%. 5-year forward break even, 2.5%. In the past 25 years, we may have had lower inflation, though, because of aging and higher savings. He does think there is a risk that the neutral rate will be higher going forward. But quite frankly, he has no effing idea what the neutral rate is going to be, and nobody does. We can only speculate on it. I speculate that it's going to go back and probably be even lower thanks to competition and innovation. He thinks it'll be somewhere in the middle. Some people think it'll be even higher. That's like, we can place bets on that. That's crystal ball stuff. That stuff doesn't matter right now. But the point is, this is a pretty neutral speech. I don't think this is the dovish Jerome Powell people were hoping for, though. As soon as you get a dovish Jerome Powell, yields plummet and all the stuff that they don't want to happen happens. So this is not unexpected. What also should not be unexpected is the deadline for HouseHack, November 1st. Make sure you go check out househack.com, read the offering circular, and get involved in HouseHack if you want to be involved in a startup. We'll be posting a lot of HouseHack videos over the next 2 weeks to show you some of the progress we're making and how fast we're making progress. Really, really exciting. We got to hit the disclaimer. Keep in mind, I am a licensed financial advisor. I'm becoming a licensed stock broker. Already passed my Series 7 and other related tests. And I am a licensed real estate broker. But despite all of this, this video is not personalized financial or real estate advice for you. I'm not short the market, long some of the stocks that I mentioned. So I got to be clear about that. This is not tax, legal, or otherwise personalized financial advice. This video is generalized perspective. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. In other words, good luck. I love y'all. I'll keep bringing updates to y'all. And you know what? I'm going to keep speaking my mind because all the little weenies who are like, oh, Kevin's only mad because of this, or, oh, Kevin doesn't see this. I see you. I hear you. If you have a good perspective, I'll say you're right. And if I think you're wrong, I'll tell you I think you're wrong. But one thing we ain't doing anymore is caring about the Karens. All right, folks. I appreciate you.